Matt, how we doing?
Pretty good, actually. This has been a really promising week. It seems like things are clarifying in a really interesting way and in a really productive way. I think for the apartment market, for the economy. My fingers are crossed a little bit, but I don't think I even need to cross them. That's how happy I am.
That's good to know. That's confidence right there.
Yeah.
Well, yeah, I think that everyone, and I think myself included, getting a little spooked with treasuries
Yeah.
rising. But I think again, it's trying to filter the signal from the noise and try to take a step back, look at the big picture, look at everything, and like what are we really so concerned about? It seems like there's a lot of speculation that's driving some of the run in treasuries,
Yeah.
whether that's immigration, whether that's purchasing Greenland, just
Yep.
anticipated volatility coming in from the new Trump administration. But if we've learned anything, people just overestimate on what actually is going to happen,
Yeah.
and the reality is significantly discounted from that. So I'm in the camp of heavily discounting a lot of this kind of just talk
Yeah.
of extreme volatility. Not that there won't be some, but looking at the real picture in the totality of evidence, it's like I think we're in a pretty not too bad spot. And CPI coming out today,
Yep.
basically, I mean
Let's
we're
do it.
not at 2%, but we're under 3%. We're 2.9 year over year, and shelter owners equivalent of rent OER that's elevated a little bit, bumped up from last month.
Yeah.
And again, we know, I mean that's 12-18 month lagging indicator. Like we know where rent growth was the last couple of years, and so like that also has to be discounted somewhat. So I think the super core is less than 2.9. So it's not as though inflation is rearing its head. Maybe it's a little stickier than folks would have thought.
Yeah, sticky's the right
could
word.
have been, but it's sticky at 3. It's not sticky at 5.
Yeah.
And 3 is not a bad number. I mean, we've had conversations in the past, especially prior to the pandemic, of whether the target rate of inflation should be 3%. Should we be pushing for slightly more inflationary policy to get to
Yeah,
3%
yeah.
rather than 2%? So we've acknowledged that somewhere between 2 and 3% is a reasonable rate of inflation for the economy, or there's at least enough economists that think that. So, from an inflation standpoint, I don't have the red lights and the sirens going off. It's only folks who are like, well, there's going to be a massive trade war and tariffs, and there's going to be no more immigration. And I'm just not. I'm more confident that's not going to be the case than it will be the case.
Yeah, I'm wondering about.
And is that the reason we're not going to buy a multifamily?
I don't think so.
So,
Well, and yeah, for our all of our signals are basically go, and we'll talk about these multifamily specific trends and what people are forecasting for the market in a little bit. But I think over in general for the economy, it does seem like I said, things are clarifying, this may be a period of more stasis rather than going crazy on inflation or going, south towards recession. We may just be in a period where it's plateauing, and it's plateauing perhaps with the economy running a little hotter and interest rates a little bit higher. That's not what people were saying earlier in 2024. That was whispered around in like 2023, 2022 was this higher for longer narrative. It has kind of come back. I haven't heard people say it a whole lot more like they did way back when. But I think it's increasingly becoming a possibility where, like, okay, if the economy has not been cowed by high rates by now, then maybe this is a neutral rate. However, my only caveat is that I think that there are things where you hike rates and 2 years later you see a consequence. And some of those are coming to light, especially in the multifamily and commercial real estate market.
yeah, I mean, there's foreclosures that are happening right now. I mean, there
Yeah.
are bridge loans that are coming due with borrowers that aren't unable to pay them back. I mean, I think there was a report in the Real Deal about Tides Equity deal that was foreclosed upon very recently. So, I mean, that type of stuff is happening. It's not systemic by any means, but it's filtering through, and it's really what we had talked about happening a year and even 2 years ago.
Yeah.
Of that, it's going to be sponsor specific. It's going to be sporadic. It's going to be patchy. There's going to be distress, without a doubt.
Yeah.
Which has come to light to be absolutely true. It's not going to be wholesale. It's going to be over here. It's going to be over there, especially in the Sun Belt. A lot of value add deals are taken at a high leverage with lines of credit, short term.
Yeah.
We know that there are some effects, and it's really the 10-year is not helping because the Fed funds rate's lower, but the 10 years up. But at the same time, the deals that were good deals have grown to a point of where they can be sold, they can be refinanced. There are deals being done. There's a lot of pain, and there could be a little volatility later on.
That's my multifamily question.
Yeah.
Are the deals that are being done now like under the mindset that I just talked about, where we may be sitting with these high rates forever, so get real or fail, or are the deals still kind of predicated upon the expectation that rates will be a little bit lower, so sellers are pricing it high and say, come on, don't you think interest rates will go down? Like, what's the assumptions going in?
That's a really good question. There's not one single assumption that's going on, but I'll talk about a couple different mindsets. Yeah. So there's the one mindset that just absolutely confident the rates are going to be way lower, which I think, I think so. And so there's basically saying look, rates are high now. We're going to buy. Rates are absolutely going to be lower. Which everything's going to be lower. It's all going to work out, and that's the reason to buy right now. And so you'd be willing to pay an even higher price if that was truly what you thought.
Yeah.
And there are some buyers that are doing that. There are others who are saying they're going to be doing less deals, but they're saying, look, I'm going to buy right now because I think overall prices are lower today than they will be in a year or two. And I'm not going to count on interest rates coming down at all, but the deal works at a higher level of interest rate.
Yeah.
And the upside that you wouldn't want to factor in is that if rates come down, you could have additional upside in the deal. You could refinance, you could sell at a lower cap rate, et cetera. I think that makes a lot more sense, the latter rather than the former.
Yeah.
It's got to work in a higher rate environment. But I think what is common between both of those is that now's a good time to buy because prices are relatively depressed and there are less buyers in the market. And we're still seeing relatively healthy asset prices in the deals that are trading, albeit on much lower volume. And so the idea is that, look, if prices are still trading in this range when rates are high, then again, that's potential that as rents continue to grow and even if rates stay where they are right now, that additional capital will eventually flow back into the market, and those prices potentially increase even more.
Okay.
So it's a good time to buy.
Yeah.
Breaking it down simply, if you believe in buy low, sell high, you're buying low now. At some point, you can sell for higher. The success of that is really dependent on if you give yourself enough time.
Yeah.
Because if it'd be hard to find someone today that would say, I'm going to buy a piece of real estate now, but in 10 years it'll be worth less.
Yeah. Yeah.
Now you could say you might not be worth enough more to justify the cost and as an efficient use of capital, but prices will rise over the next 10 years in real estate. There hasn't been a 10-year period where real estate prices went down. But if you have a 2-year window where you're hoping that needs to happen, you take out a bridge loan. And that's where I've heard a lot of conversations from syndicators out there, and it's not wrong, and they've got some good points, but basically saying that hey, now actually is a good time to be using bridge loans, which there are some cases where I would agree on a value add. If it's a good value add, if you're buying a high quality value add deal with a true value add business plan, I can make sense of that. But if you're buying a stabilized deal with not a big value add component and you're using short-term floating rate debt, there's no guarantee the rates will be lower or you can fully execute your business plan within that 2-year window. I think probability says you probably could. And if rates stay the same, probably would work out if you get the lift on the value add. But there's just a lot more risk in doing that.
Yeah.
The reason why people are saying that, though, is because the 10-year treasury is so high. Yeah. And it looks now unpalatable, even with a higher spread on over SOFR that a bridge lender would give you.
Yeah.
But they're saying, look, maybe rates are going to come down more. I'm going to be on this floating rate debt. The rate will decline, even though I have to purchase a big rate cap during that period. But it's not only that, though, it's just proceeds, because if you're paying a lower rate, that means your DSCR is going to be more favorable, your debt service coverage ratio, the amount of cash flow you need over your mortgage payment. that the lender wants to see. If you have a higher DSCR coverage ratio, you can typically get more loan proceeds based upon the terms of the lender. And so, if you're buying a property for $10 million and the agencies are only willing to give you a $6 million loan, but the bridge lender is willing to give you an $8 million loan. Now, even though there's more risk, the returns look better because it's less equity, higher leverage. And so, if you're looking at a deal that's that's marginal and it's a 13% IRR on the agency debt, but it becomes a 16 if you're using a bridge loan, you're like, well, this deal does work, but we have to use a bridge loan.
Yeah.
And then you have to justify all those risks to yourself. So I'm seeing that happen right now, which again could all work out. The right strategy, right operator, it will, but got to be careful.
Yeah, and this calls to mind there's a little bit of cognitive dissonance with yes, the Fed funds rate is going down or it is decreasing, but 10-year Treasury is as high as it's ever was when Fed funds rates were peaking. I don't think the 10-year was as high as it is now, or at least there was a brief moment last year.
Period that was it basically brushed 5%. It got to 4.99.
Yeah,
and
yeah.
We're yesterday we were 4.77. We're a little bit lower today with a healthier CPI report.
And we can get into that right now if you'd like. But that's what it just does seem strange. Even admits that there's something going on here.
Well, ask someone to see if someone follows the economy, or ask them if interest rates are up or down. It's a trick question.
Yeah, that's a good point. What point do you want to make?
And it'll tell you what type of debt they're focused on. If they're like, hey, rates are down, right? You're doing something that's a spread over SOFR floating rate versus if rates are up right now, you're doing fixed rate because you're looking at treasuries.
Yeah, interesting. There's always something to cover.
always. Okay. CPI report, Matt. Again, I think that the market seemed to be relatively pleased with this. Stock market was up this morning. Bond yields were down. Good news for just folks who want a kind of a nice, steady, healthy economy. And this is, we had a little reprieve from this conversation. The cycle that was the last 2 years of. I took it as plus every 3 weeks or so, the narrative would go from danger, recession imminent, rates higher for longer, inflation out of control, get into the bunker, and then 3 weeks later be like, no, all is good, balance, zen, totally fine, don't worry about it. And if anything, the zen scenario is the one that we're sort of living in. Not that everything's perfect by any means. We just talked about foreclosures and there's pain going on, but that soft landing kind of sweet spot. No one wants to admit that because no one wants to just look around and say all is good, because not all is good in the world. Los Angeles is burning. There's all these problems that we always have, but man, it could be a whole lot worse, and we should be a little bit appreciative of the economy is not absolutely in the dumpster right now.
Yeah, for sure. I'm pairing this with a positive jobs report too. But all items inflation up 2.9%. It was 2.7 or 2.8% last month, so it's up slightly actually compared to the previous month, but it's lower than expectations. I'm kind of interested in what those expectations are, and I don't know what they are. If they're just like a random person, I can give them expectations every month and they can beat them. But I don't think.
Your expectations, man, are just as valuable.
Okay, that's what I thought. But either way, whoever's doing the expectations and whether I don't like inflation going up, even if it's going up less than expected. 0.4 month over month inflation is also high, a little bit higher than it was a previous month. I think holiday spending probably elevated this figure. At least that's my own personal explanation. But at least shelter has gone down slightly. However, the rent of primary residence component went from 0.2% month over month growth to now 0.3% month over month growth. So it's a bumpy ride for these rental figures. I don't know. I'm going to kind of take some solace in the month to month volatility, and maybe we'll see a continued dip in rent of primary residence. However, that one is around 4 to 5% as well. Add this in again with the jobs report showing very strong growth. You've got some additional support to that argument that the economy is going to run more hot than cold. Maybe this includes high rates as well, relatively high, and but there is good news in that core, which is all items minus food and energy, is slower. It grew slower than the previous month. It grew by 0.2% month over month and 3.2% year over year. So if you're taking out the food, energy, and arguably you take out shelter, and you're really down. You're really down significantly, and there's some reason to think that this is like a bumpy stability. So that's the positive take. Again, if you are focused on like just the nominal increase, it's not great. It's not like a convincing downward trend of inflation. So that's a little bit of a bummer, because I was tracking this. This is one of the after hearing about the jobs report last week, that's when my ears perked up about the CPI. I think when you mentioned it, how it used to be the CPI, we were on the edge of our seat every month, but lately in the past few months, it's like we could skip one. It's not as loaded with importance. But
I think that there was a little bit of a sense when the Fed decided they were going to start cutting rates that it was they were specific not to be like a mission accomplished moment, but it kind of felt like that to a lot of folks. The fact that we had pivoted, the Fed had pivoted, was a sign. All right, we were clearly in a different new paradigm, and we thought that we'd be out of that 3-week cycle, because it was like no, it was finally confirmed which direction we were heading. But then soon after that, it seemed to be a not so fast. We need to still be aware inflation may still be sticky. Yeah. And again, would we be even having these conversations if it wasn't for Trump being elected?
I was thinking about that too, and I wonder how much the narrative is going to change. And like regardless of the party, like the fact that the party switched, they were looking for economic change, and now sentiment has changed to positive.
Well, we've seen you've showed us those graphs so many times of the sentiment based on party affiliation, and how it absolutely just
flip-flops completely. It's
and so
funny.
Are we like witnessing the flip-flop? Is that this narrative? Is that the realization of that flip-flop in the bond market? Is the political sentiment of people just flipping good from bad, glass half full to glass half empty?
It could that could be. That's what's so interesting. And I was listening back and remembering from last week when we were talking about the 10-year Treasury rates and like the federal funds rates compared to other countries. I think that the high rate though is rooted in people's expectations of like inflation kind of. That's because of things just seem to be running so much hotter. I don't know.
But you're managing a $1 billion bond portfolio and you're trying to model something, and someone comes to you and they're like, we have to reanalyze the effects of the administration if full on tariffs, 100% tariffs happen. Trump has said he's going to do this, model that. He's going to block off all immigration. He's going to deport all these people, model all of that. Oh, well, that's really extreme. Okay, well, let's discount that. Yeah. Instead of 100%, let's do it at 50%. But reasonably, maybe it's going to be 10% of that.
Yeah. That's a really good point.
I was just reading a little bit of World War II naval history, and Japanese intelligence services. Prior to World War II, and halfway through, were like some like the best in the world. Of, just giving intelligence of ship locations. And everything. It got halfway through the war, and the United States, was winning engagements. Higher command started classifying the intelligence as defeatist, and they started to not believe it as much, just because it wasn't going the way that they wanted to go, and they didn't want it to hurt morale. And on one report, the naval intelligence on one major engagement, the one intelligence service basically said the Japanese fleet took out 19 aircraft carriers, basically decimated the U.S. fleet. Yeah. The Japanese naval intelligence basically said, well, the United States doesn't even have that many aircraft carriers, for one. We actually didn't sink any ships, and we lost our entire air wing. We
Yeah.
don't have any planes. They kicked our ass basically.
yeah.
They refused to acknowledge that, and so then they were planning another engagement. Basically, we had one source saying, we wiped out all their ships. They don't have any planes.
Yep.
You have another intelligence services. We didn't take out any of their planes. So you know what they chose? They said, well, we're going to assume they have 50% of their force as a
great.
compromise.
Yeah.
well, they have their whole force.
Yeah.
And so when you're
Yeah.
looking at
true.
extremes,
Yeah.
and you just need to make a statistical decision for your model because you don't know.
Yeah.
If you choose a number like 50%,
Yeah.
but it's so far off from reality because you're relying on just statistics.
Yeah,
and-
there's a binary.
and
yeah, that's such a
assumptions
good point. Yeah,
rather than a
it's like
little
splitting
bit
the
of luck.
baby, kind of. Yeah,
Yeah.
Where you got the worst of both worlds. There's not an operative. Yeah, really, really good point. And I think that it is one that is especially relevant for multifamily investors or buyers. To you don't want to go halfway. Yeah.
I think that there's a quote for the emperor. No idea if they actually said this or it was just made up. But these great naval victories we keep having, they seem to be getting closer and closer to Japan.
Yeah.
And I guess the analogy that I would say is that all these problems in the market. Well, the stock market, which isn't perfect, keeps going up. Relatively, and multifamily deals keep happening, and prices have not only kind of stabilized, but they've ticked up a little bit.
Yeah,
and there's a lot of buyers in the market. Not that
they're
Treasury's being
concurrent
this
trends.
level.
Yeah.
The long-term trend is very positive, and so are you going to listen to some decision that some bond analyst is made when they're trying to make a decision on what Trump is going to do? That's what's driving this.
Yeah.
And even though last week I was talking about a lot, Treasuries are running, it's a risk, which it is. But if you get into the why, it all of a sudden just seems like an overreaction.
Yeah, because we talked about like it has rhetorical force, what he's saying, but maybe not policy. Maybe it's not for the policy specific force that you could be using.
It's like, we want to know exactly
error.
so we can put it in our model.
Yeah. Well, good luck. And yeah, the past showed that those numbers are often easily fudged. And if you want to get into the jobs report, we can talk about December 2024 jobs report. Strong finish. I know that the cynics will say, "Oh, it's probably mostly government jobs," or "Oh, those will be revised downward." That's the two most common things to hear after a strong jobs report is to focus on.
Down.
It's like poke holes in it, but I think strong numbers are strong numbers. Ironically, they did revise some of previous months' jobs numbers up this month. I think jobs are jobs. You've got to find some good news in here. It says, notably, wage growth does not appear to be re-accelerating. I read a little bit about of this in the BLS's numbers specifically. Real wage growth is not accelerated, maybe decelerating slightly. So
Yeah.
256,000 jobs surpasses expectations. It's the largest increase since
you say that, but
March
it's still
2024.
it came in at 3.9% the wage growth. So I mean, it may be decelerating, but it's decelerating from a pretty healthy number.
Yeah, it's still healthy, but like
we probably need it to decelerate a little bit for inflation to play.
Yeah.
Nice.
And it may be going down like the month over month numbers may be a little different, but that's splitting hairs. It's fairly stable, and it's stable at a 3.9. Great. Yeah, it's above. It is above inflation. So that's
unemployment rate ticked down to 4.1 from 4.2.
Yeah. So all of these are really strong signals, and for that tick down in unemployment is notable because it has been slowly growing every month, but still we're well within like a cushion. We're below 5%, which is a level that people usually say, well, you get above 5% unemployment, then you can start maybe writing some headlines. But it does seem like we are in this bumpy, higher, a little hotter. So whether you're talking about wage growth, whether you're talking about price growth, a little bit of hot, a little bit of stability, or maybe even population growth.
Maybe even population growth. This was interesting, Matt, because a couple of weeks ago we did a research report from the Harvard Joint Center for Housing Studies. It basically said like, hey, 2025, things might be fine, but hey, 2035, 2040, we might see some declining population. Watch out, might not be good for housing. but this paints a little bit of a different picture. And
Yeah.
you made a really good point of like, good luck trying to predict something like 15 years out.
Yeah, yeah. And I think there are broader demographic shifts, certainly, but the relevance of immigration in population growth is such that it's hard. It makes it hard to predict because from one presidential administration to another, immigration policy could change dramatically. And I think it is great to see that this U.S. population growth is the highest it's been since 2001, and this is also, I think, a counterpoint to a recent Congressional Budget Office report in which it has revised its population growth estimates downwards. I do think it does, shows how hard this stuff is.
Yeah.
But
what are they saying the driver? Is it immigration?
it is, yes, net international migration was a critical demographic component of change driving growth in the resident population. With a net increase of 2.8 million people, it was 84% of the increase in population. So that is how sensitive we are to immigration as a driver of of population growth. We'll see what this balance is between the interests of this H-1B visa conversation is and just like the illegal immigrant conversation as well. I think that
it's good that we have that. At least the conversation has become nuanced enough to where it's not just immigration or no immigration, because it should be a super very nuanced conversation. And at least we're saying that like, okay, we definitely need some immigrants. Like, can we all agree that we definitely need some? We don't want criminals, we don't want terrorists, but if you want to come here and work hard and kind of follow generally the rules and be an American, like, come on.
Yeah.
Like, we've got an unemployment rate of 4.1%.
Our incoming president married an immigrant.
Yeah. Yeah.
So
yeah.
there you go.
Well, yeah, exactly. You can't like not like them that much.
Yeah. There for multifamily, for a lot of these people that are there is talk like kind of among right wing circles. I think Elon Musk talks about it a little bit about like fertility rates, population rates. Population bomb's going to go off. Well, immigration is a tool there to bring some stability. I don't think anyone wants illegal people to come in, and I'm going to say this: people are going to get really mad. Immigrant population has a lower crime rate statistically than natural-born citizens, than citizens, period. Immigrants have a lower crime rate than citizens.
I don't get caught, we'd be deported.
Yeah, exactly. Well, yeah, there's that there, but it bears repeating that in places where immigrants move in, crime rate actually goes down. That doesn't erase fears of the specific acts of illegal. It's just the thing, like, you got to understand how numbers work. Okay, this one horrible thing that one illegal immigrant did. Well, there are actually a lot more.
They all need to go. Now they all need to go.
Yeah, I guess. But sometimes it does.
Well, I think we should also agree that you shouldn't be able to. Murder's illegal.
Yeah. Murder's illegal, and they're
illegal things. Nobody can do illegal things.
Well, and I sympathize with the strain on resources that influx of immigrants can have to certain communities. Like, you can't just dump a lot of people in a place that doesn't have the capacity to either employ or support or school them or give them healthcare. Like, there's a lot of things, but I still think we need population growth. It drives the economy. Unless we want to shift into a different form of economy in the United States where it's more of a stable growth, population stability. It's more of like Great Britain or something.
Sounds a little more socialist to me, Matt.
Exactly. So what do you want? Do you want the growth or do you want the stability? I think that require just a lot of retooling of expectations if it moved to like steady as she goes forever and ever. Who knows? I think we can pack more people in here in this country.
I always like to say freedom isn't free.
Yeah. All right. Good. But this and the jobs and the CPI, it does paint a picture of growth. And we'll see if it continues. There's obviously great big question marks, but the trend that has been established through the end of 2024 was one of increasing growth, increasing demand. And we may even see this in the real estate market too.